Well, our next guest warns the U.S. is on a collision course with a recession. Peter Boockvar is the Chief Investment Officer at Bleakley Advisory Group and a CNBC contributor. Peter, good to have you with us. You say there's 3 stages in a bear market. We're only in the middle right here.
Right. So the first one is a valuation adjustment, which we clearly have seen. The second one is the economic impact and also the earnings impact of a slowdown. And then the third one is when everyone throws in the towel. And I can argue that we're really just beginning the first phase of part number 2, where growth is slowing and we're beginning to see the impact on earnings, particularly profit margins. And I think this still has a ways to go to work through door number 2.
Peter, it's Tim. So independent of necessarily what they're going to do, what do you want the Fed to do? You're someone that's been critical for a long time about the Fed's transitory language and other such folly. And so wouldn't it be great news to see the Fed continue to hike and push us into recession? I'm kind of teeing you up for the answer that may not be the one you want to give.
Well, I think Powell wants to get to 3%, which he'll get with a 50 basis point increase in September. And then he can even calibrate it down to 25 basis points thereafter. So I don't think there's necessarily the right level of the Fed funds rate that's going to get to some magic level of lower inflation, because we just don't really know once you get above 3. Because when you look at previous rate hiking cycles, it was lower and lower levels of a Fed funds rate that started to break things. It was 2.25, 2.5 that did so in the fourth quarter of 2018. And previously it was higher than that, but each successive rate hiking cycle ended before the previous one because something broke. So now we start getting into dangerous territory where things are at risk of breaking. But the important thing also is this balance sheet reduction that is only barely just begun. And I still like to separate out the interest rate increases that impact negatively the interest rate sensitive parts of the economy, like housing that we saw today, and it's already slowing autos. And then QT, which will have a direct impact on financial conditions and the markets. And I think Melissa made a great point just before, saying that the markets really are playing a game of chicken with the Fed. But it's the same playbook. Oh, maybe the Fed is going to be done raising interest rates soon because inflation is topping out. Therefore, you got to buy. And I think people are not being sensitive enough to this economic slowdown and what it's going to mean for corporate earnings and profit margins.
Hey, Peter, Jeff Mills here. So based on this environment that we're describing, how would you tell our viewers to be positioning right now? I mean, are you still looking to play the momentum of some of the growth stocks that we've seen lately? Is it more on the value side? Where do you think the opportunity is?
It's more on the value side. I'm still pretty bullish on commodities generally, acknowledging the pullback because of worries about the demand side, but still very bullish on the supply side challenges. And I think value is still going to well outperform growth. I think the valuations in growth stuff, even with these declines, are still rather expensive, where there's still a lot of forgotten value names that have already have low expectations already embedded in them.
Peter, great to see you. Thanks. Peter
Thank
Boockvar
you.
of Bleakley. Dan?
I love Peter's work, and I've followed it for a very long time. I would say this, though. The but is this.
Okay.
If we're done going down, let's say we have another test like somewhere like 3,600, 3,700 or whatever, and then everything holds, right? The same stuff that I think led us in the last leg of the bull market, I think is the stuff that's going to lead. Like, I'm not going to want to go to value. I'm going to want to go to perceived value, the sort of like stocks. Well, I think those, but I think it's the stuff that's down 60, 70, 80%. The quality names, like a PayPal, some of the names that we've been talking about over the last few months, I just think that's where you're going to get a lot of bang for your buck.
Well,
in that first stage. No, not value. But what I'm saying is I don't want to go to energy. I don't want to go to financials or home builders or stuff like that. I want to go to the stuff that was working really well in 2020, 2021, the stuff that I think is going to be around in 3, 5, 10 years.
Yeah. Jeff, you still make the case for big cap tech as defensive?
Yeah, I think so, honestly, because if you're thinking about financials or industrials or materials, like that's not what's going to pop if, in fact, inflation continues to go down and the Fed at least gives some signs of slowing down. So I think you do want to focus on those quality growth names. I still really believe that you're going to see a reduction in earnings expectations for next year, even with the reduction in expectations we've already seen. So I think you want to be in those names, like Dan said, that have already seen that multiple compression, that are going to be able to maintain some semblance of earnings growth. I really think that's where investors are going to be looking for value as we move into the end of the year here.